Tesla's Q2 2024 financial report just came out, and they dropped a huge stunner, an enormous gold nugget in their energy division. And we're going to share it with you today. Maybe Matt, you could tell us a little more about this, and Larry can get into a quote from the earnings call, and then we're going to dive into a spreadsheet, look into this issue, and show you what we think it could mean for Tesla's earnings moving forward.
Yeah, sure. So the item in question here is unsatisfied performance obligations, which does not sound interesting whatsoever. And unless you're a bit of an accounting nerd like Larry, myself, the three of us here, it's very easy to understand why you may have missed this, or it's not getting the attention that we think it deserves. Larry, I would say UPO pilled me. So this is the unsatisfied performance obligation, or UPO as it's known. It's essentially this, it's a bit like deferred revenue conceptually, in that it is future revenue from kind of current period deployments that Tesla Energy is going to be recognizing. But there are some pretty important caveats and differences from deferred revenue. The most significant of which is we believe it's going to be extremely high margin revenue. So Larry did a great job bringing this to light to the Tesla community. I was just thinking about the journal entries as Larry was describing them to me, where I had been thinking that this UPO piece of the business would have kind of comparable margins, 25% gross margins, just like the rest of the hardware business. And Larry really convinced me that that's not the case. Larry, I'm kind of curious, anything I missed on that setup, or what?
No, it's exactly right. So for a long time, Tesla had kind of combined the UPO and the
deferred
hadn't combined, but that in one paragraph that covered the UPO as well as the undelivered contract, the work in progress piece. And so we didn't spot it. But as I was working through, I think the quarter before last, I began to see this amount. And then Cern Basher actually, he posted about it, and I started delving into it, and I discovered that there was really a true UPO component here, and it doesn't constitute any cost to the company to deliver that component. So it became clear to me we had a very, very big, Easter egg in this item.
So let me say at a high level what this is Tesla delivers the Megapack to the site, but it's not immediately plugged into the grid, and they don't immediately know what the performance of the Megapack is. So this UPO is like, how is the Megapack performing once it gets plugged in? Is it performing according to spec, that Tesla can get that final payment from the customer? So these are, as long as the batteries are working, this is money that Tesla will get. And Tesla wrote the contract, so they are like highly confident they're going to meet certain metrics or exceed them.
Yeah, and so Tesla is on the hook. I mean, these Megapacks are 3.9 megawatt hours kind of rated capacity. If for some reason they only meet 3.5, a particular Megapack is just below spec, Tesla actually has to make a monetary payment called liquidated damages to the customer in order to make them whole for the amount that they paid relative to the performance that they're receiving. So there is an actual potential obligation here, which could, if it's a very high obligation, that would eat into the margin potential that we're talking about here. But assuming that there's not kind of widespread rampant defects, then it stands to reason that the majority of this revenue will be recognized by Tesla, and there's no cost associated with it, which is extremely important. So therefore, the kind of gross margin potential is extremely high, as we'll get into in a minute here.
So Larry, you found this quote during the earnings call. There wasn't a ton about Tesla Energy, even though that's probably the biggest bright spot from the production and deliveries report.
Yeah, so
on this nugget.
Yeah, so there's this conversation between the head of power engineering, Vaibhav, the chief financial officer, and Elon, because somebody questioned whether the energy business was just going to be very competitive and prices were going to collapse as they had in the vehicle space. And Mike said, yes, there's a lot of competition from Chinese OEMs. And he says, we're making sure we're remaining competitive where they're needing to be competitive to secure contracts to sell power and energy in the markets. He said, we feel pretty good about where we are. We realize competition is strong, but we have a pretty strong value proposition, offering a fully integrated product with our own power electronics and site level control. And then Vaibhav chimes in and says, yes, again, the aspect which people do not fully consider is also the whole software stack that comes with the Mega Pack. And that is a unique proposition that we have. And Elon adds, yes, we find customers, they can sort of put together a hodgepodge solution, and then sometimes they'll pick their solutions. And then when that doesn't work, they'll come back to us. And so clearly there's a differentiator, and it all turns on this, complete package, including the software stack that Tesla Energy is able to deliver.
And I want to maybe just chime in a little bit on the perspective of the customer on this, because I was working for a power plant operator for a number of years and was actually working on project financing for individual projects where we had to meet certain kind of power output requirements of our power plants. And we were looking at adding stationary storage to these as well. And in order to get these projects actually financed by a third-party lender, you need to have essentially guarantees that your plant is going to work the way that your financial model says that it's going to work. And the only way you can really do that is by having these types of guarantees. So if you're kind of going to the low-cost bidder who has a hodgepodge and won't actually give you a guarantee of the output of your batteries, you're going to have a very hard time getting financing in order to actually get this project executed. So what Tesla is saying there is not just something that sounds nice. Like, it's actually a necessity if you're going to be trying to deploy these at scale by parties that want to have them financed by tax equity or by lenders of some sort. So Tesla's ability to kind of prove the revenue capability from their software suite, as well as providing like rock solid guarantees on the performance. They're essentially kind of wrapping the performance of the battery in a similar manner to what an EPC or an engineering, procurement, and construction contractor would give you those types of guarantees. And so that's an extremely compelling value proposition from an owner operator standpoint who'd be buying these batteries.
All right, so let's see how much Tesla can make on the energy side. Let's dive into some of the numbers.
All right, so we've got a model here, and this is kind of hot off the press. Been working on this most of the afternoon here. This is at least at time of recording the day after Tesla's earnings. This is Wednesday, so potential we got some stuff here wrong, but we wanted to really just kind of take a crack at laying out the opportunity as we see it, and we'll probably fine tune some of these assumptions going forward. But we think directionally this is about right. So to get to Larry's point about why this popped up, I've been looking at Tesla Energy for a long time. And if you look at Q1 2023 as an example, you had the long-term portion of the UPO at 197 million and the short-term portion at 12 million. The short-term portion or the current portion just means the amount of this of the revenue that they expect will be recognized in the next 12 months. So, $200 million over the future 12 months, nobody really cares. But what's happened over the subsequent many quarters is that this balance has just grown and grown and grown. 3.4 billion by Q4, 3.9 billion in Q1. And then like the huge spike as deployments increased so significantly in Q2, this jumped to $5.7 billion. So $5.7 billion in revenue potential, 2.5 billion of which will be recognized over the next 12 months. And keep in mind, like, this is on a part of the business that's doing $3 billion in quarterly revenue right now. So you've got an extra quarter's worth of revenue on top of this kind of run rate that you might be expecting going forward. So just very, very meaningful amount of revenue. And if it is this very high margin revenue, like we think it could be, then it has the potential to be a bit transformational. So
I just want to add one thing, Matt, if I may. One of the most interesting aspects of this last quarter's numbers, it really confirmed my suspicion, because I had modeled a revenue income from the current portion in this quarter, and we exceeded the amount. We didn't reach the amount, we actually exceeded the amount. So I feel very comfortable that these figures are going to be, real.
Yeah,
Let me put this in context. So that number in G15 and 16 combined grew by 1.85 billion in one quarter. And if Tesla can satisfy 100% of that, that's an additional 1.85 billion before tax in profit for Tesla. Now they may not necessarily get 100% of it, but we'll show our assumptions here. But that's a really big deal. Like if you can convert that much extra amount into profits on a quarterly or annual basis, just stack those 1.8 billions for a while until we see the battery prices come down. It's going to be huge for profits, and we're going to show you that by the end.
Yeah, and I think this is like the complications of modeling this out are one of the reasons why it's probably gone unnoticed. So we've got this really big increase in deployments quarter over quarter, which translates to the huge increase in revenue. But it's not just that; it's this $1.4 billion increase in revenue quarter over quarter, plus the 1.8 billion that Bradford highlighted. That's going to be kind of future revenue. So I think what a lot of analysts might be doing is simply taking the total energy revenue, let's say this $3 billion, dividing that by the deployments and saying, okay, Tesla's selling for $321 per kilowatt hour. Meanwhile, we know that their average pricing has been more like $450, $460, $470 per kilowatt hour. So the fact that you've got this kind of big hole in your ASP is actually very supportive of the fact that you have this future this big component of the ASP, which is tied to the UPL. So what we wanted to do for modeling purposes was try to figure out, okay, how much of the ASP actually is the UPO? So what we did is essentially looked at the change in the total UPO each quarter and then divided that by the deployments in that quarter. So since UPO is ramping so significantly, almost all of the balance in here is really going to be related to increases in deployments. So it's extremely lumpy when we do this. And so for that reason, it's very clear that you like the establishment of the UPO, or in other words, the establishment of an obligation that Tesla has to an individual customer does not appear to be tied to the actual deployments. It's probably a different contractual milestone. It might be at the time that the contract is signed that this obligation is created, or shortly thereafter, but it's not exactly when the deployments happen. That said, we can kind of look at this increase or this average implied dollars per kilowatt hour over this entire 5-quarter period to get an estimate. And so when we did that, we're coming up with an average UPO price essentially of $202 per kilowatt hour. That strikes us as a little bit high, given that the average ASP during this time is probably going to be around $475. Keep in mind this is the ASP, not the actual dollar revenue amount. So we took an estimate that the UPO would correspond to around 30% of the total ASP. So this gives us a good methodology by which we can continue to grow the UPO balance. So what we've done here in these columns is said, okay, how much of the current portion of the UPO is recognized in any given quarter? How much of the long-term portion transitions to the short-term? And then how much of the current portion or the short-term gets added based on new projects that are added, new gigawatt hours being deployed, as well as the long-term portion from new gigawatt hours that are being deployed. So when you do this and you kind of mix around the balances between the different long-term portion and the current portion, you can get to an overall projection of this UPO going forward, as well as the fact that you're now seeing, okay, how much did I fulfill in each quarter? Now you've got a methodology by which you can forecast not only UPO revenue, but also UPO margin. So we have an assumption around gigawatt hour deployments increasing. I won't go through all the details, but just with Lathrop and Shanghai being ramped to full capacity, that would be 20 gigawatt hours per quarter, which is an amount we're not reaching until Q2 2026. So it seems reasonably conservative to me. So we're not trying to, kind of come up with any crazy numbers. We think these are, I would say, actually a reasonably slow ramp of how these deployments will take place. Getting back down to the projections here, we have an ASP of the mega packs that are being deployed in any given period. We're assuming that that's going to tick down, so that the current pricing for a mega pack is somewhere around the $250, $260 per kilowatt hour range. As the older contracts, which had higher pricing, go through the deployment phase and get worked out, we think the ASP is going to be coming down to this $235 per kilowatt hour range by 2026. And this will be the amount that's actually recognized by Tesla. One other thing I should have mentioned is we're making an estimate of the gigawatt hours that are deployed in any given quarter. What percentage of those are recognizable within that quarter? We don't know what this exact figure is, but we do know because of the milestone revenue recognition terms that Tesla has for under their accounting treatment, that they're not recognizing 100% of the revenue at the time of deployment. So you've got to make some estimate of how much of the total ASP is deployments, how much of it is this UPO piece, and then how much of it is just recognition of the hardware
prior milestones, right?
From prior milestones, exactly. Yep. So now that we've got this all kind of established, we can calculate the deployment revenue. It's just the deployment ASP times your deployed units up here, your gigawatt hours, and then multiplied by the percent that's recognizable. So then you can do the same thing with the UPO based on this math that we were showing up here, where you've got 256 million being recognized from the prior current balance, and then just increasing that forward over time. Now, as we said kind of at the outset of this video, the margin on this stuff we expect to be extremely high. So here we're assuming 90% gross margin, and that's one of the most kind of important assumptions on here, is that these actually are almost entirely pure margin dollars that we're recognizing.
Probably the real number is going to be closer to 95%. Like Tesla writes the specs in the contracts. There should be a high degree of certainty that they meet these specs when it's turned on. Larry, did you have some thoughts here?
Yeah, it's very important to point out that so far the actual recognition has been very consistent with the prediction, and so that's very important because you can say we're going to get so much money out of this additional revenue source, and you can project it, but they're actually earning it quarter by quarter as they are projecting it. So that's a very important consideration, because it looks like they are actually getting this revenue from the source.
You're talking about Tesla, their projection on what they're going to be making and what actually happens.
Right.
Moving down through the model now, obviously you just take this gross margin and times the amount that's recognized in a given quarter, and then you get a contribution margin towards the overall energy gross margin. And then we can do the same thing on the hardware side. So on the hardware side, I should note that we're assuming a 20% gross margin on the hardware. So lower gross margin than Tesla has been recognizing historically. And the assumption is around 20% hardware margin, and then 90% UPL margin kind of averages out to the 25% gross margins that we've been seeing in Tesla Energy. There's also a little bit of a solar piece, which is probably dragging it down historically, but that's becoming increasingly irrelevant. So for the most part going forward, it's going to be almost entirely energy revenues. Then we have this total revenue estimate. This is the deployment plus UPO that we just estimated. Then we have an estimate of the amount of the prior deployments which are being recognized in any given period. This methodology we may revisit to try to make it a little bit more accurate, but it's at least a reasonable kind of estimate of how much of the prior period deployments are being recognized. And again, these prior period deployments, we're assuming they have an inventory cost associated with them. So as the revenue is recognized, you're getting that 20% gross margin. Again, not the 90.
We're assuming the next quarter there's going to be a drop in deployments. Just to be a little conservative, but also the CFO, I think, hinted that it's not going to be just like 9.4 and have this smooth line every quarter, that there'll be some lumpiness.
Yeah, in base, 9.4 would basically be saying that Lathrop is currently at full capacity and has been for some time, which strikes us as unreasonable. So I think the more likely scenario here is that Lathrop was producing more than this, 4 gigawatt hours per quarter or so that we're seeing here, but maybe that wasn't all deployed. Maybe an inordinate amount of that was deployed in Q2. And so I think it's a reasonable assumption to assume that backs down to some extent in Q3. Now Lathrop's continuing to ramp. Elon said previously he thinks they're going to get there by year end. Wouldn't surprise me if they're a little bit faster than that already. But I do think everyone should be expecting a kind of a decrease in Q3. for those reasons. Now we have all the components that we need to look at the energy gross margin overall. So we have the UPO cost of goods sold, we have the total revenue here, the UPO cost of goods sold, and then the deployment cost of goods sold, which is really like the hardware piece of it. And then that gets you to a total energy cost of goods sold, and then a total energy gross margin. So what's very notable here is that we're assuming a very significant increase, around 7% increase, or 700 basis point increase in gross margin going from Q2 to Q3. And that might seem like a crazy assumption. And in fact, we did a fair amount of head scratching on that to see if does that actually make sense? Is that a reasonable kind of output of this model? And I would say that there's a fair amount of uncertainty around exactly if that will happen in Q3 or not. But what we come back to is the fact that you've got, this is exact from Tesla's 10Q. As of December 31st, they had a UPO balance that they expected to recognize over the next 12 months of $1 billion. And as of
March
Q2,
31st, and then this one's June 30th.
Sorry, yeah, you're right. And then in June 30th, that amount had increased by 2.5x. If this is all very high margin revenue, as we've made the case for, then it actually stands to reason that as you're significantly increasing the amount of this high margin revenue that you're going to be increasing over the next 12 months, your gross margin should see a pretty significant bump just as a result of that. Now, we have assumed a little bit of tapering, so it's probably going to be a little bit back half weighted, but even still, the increase in gross margin is pretty significant. And then you can see going into the later quarters, this gross margin increases up to 40% as you're seeing more and more of this UPO revenue being recognized. This gets offset a little bit as the ASPs come down, but overall,
then you have Shanghai coming online, right?
Shanghai's coming online, yep, which is inherent in the gigawatt hour deployed assumptions. Mm-hmm. But ASPs are also coming down, which does create a little bit of margin pressure, which just kind of assures that this gross margin on energy doesn't kind of run away up towards like 90%. As ASP comes down, it's going to kind of asymptote, around this 38% figure. So this is very meaningful, and we'll just get to a couple other points in this model. First, the EPS contribution. This is very rough estimates, but just looking at next year, for example, our estimates are that Tesla Energy would be contributing $1.10 in earnings per share. There was a UBS report like a month or two ago that was basically estimating it was like $1.10 or maybe $1.50, but by 2030. We think we're going to get there next year. So this is a very big, if true, kind of assumption. And I would say even if the UPO isn't quite as good as we think it's going to be, and again, I think it will be this good, but if it's not, the increase in deployments alone, I think are reason to think that we're going to have very meaningful EPS growth just on the back of Tesla Energy.
And so then what that might grow to the next year, I'm curious.
Sure. So in 2026, this would be $1.45, and then in 2027, it'd be $1.90. Very, very significant growth. And then there's no reason this doesn't just continue into 2028 and beyond. I mean, they've got terawatt hour scale ambitions, and in the last year of our projections here, we're assuming 124 gigawatt hours. So they need to almost 10x that amount in order to get to the ambitions that they talked about. I think the original goal was lighted around 1.5 terawatt hours by 2030. I don't think that's a reasonable.
I'm just cogitating on these numbers, and I'm thinking to myself, gosh, if we were to value this company, it would be in close to the $200 mark value per share.
Just for energy?
For energy, yeah.
Yeah, it's kind of an interesting, so let's just do like a little live math here. So, you've got 2027 revenues of earnings of $1.90. You got 2026 revenues earnings. Geez, I need some rest. $1.45. So you've got earnings growth of 31%. So what kind of PE ratio would you put on that business, given the growth prospects that it has ahead?
At least 30.
So yeah, let's go.
If not 40, probably 40.
Say 20.
All right. So that'd be $38 of value in 2027. So
just for 1 year.
Well, no, I mean because this is a PE ratio applied to it. So
okay, so you're doing a PE ratio in that year of that year. I was looking at 20 to get there. All right, so that's going to be much higher. That's probably going to be closer to 50.
Yeah, that's kind of more what I was thinking. So, that's $95 of value. Now, granted, that's 3 years out in the future. So if we take that over, let's just say 1.12 to the third, present value of $68. Would have been great if that was 69, but I think like $68, like I think these are pretty reasonable assumptions, and I think almost nobody would be ascribing $68 in current share price value to Tesla today. But to me,
and I'll make the point.
Tesla earnings, energy, yeah.
I'll make the point that Elon said on the call. He said that the actual output with Lathrop and Shanghai is not going to be double the current 40 gigawatt. He said it's going to be more like triple. So these numbers are incredibly, conservative, I think.
Well, we have that in 2027, Larry. So we got 120 gigawatt hours in 2027.
No, but you've got 40 gigawatt hours in total.
So in 2027, it's close to 120.
Yes, I see. It's 4 quarters.
But like we only have 2 mega factories, and I think we have a conservative assumption on how quickly Shanghai scales. Yeah.
Yeah, there's, I mean, the way that I'm thinking about it, like Lathrop and Shanghai is 80 gigawatt hours. I think Nevada is probably 20 when that gets ramped up. That's dedicated to stationary storage. And it wouldn't surprise me if Shanghai actually increases to something like 120 or something like that. So we could very well end up in a scenario where this is more like 150 gigawatt hours, something like that. And then in that case, then of course these numbers are just even higher. So numbers.
Let's just put this in context of Tesla's total earnings that they just reported. They're going to be lucky, or am I wrong, that they'll have $2 in earnings in total this year?
Yeah, they'll do a little bit better than that, but not much.
So we're talking about adding like essentially another $1 in earnings potentially, or maybe a little less than that. But it's $1.10 is the total energy division, so it's not the added amount, but this is a pretty large step up.
And so this is a lot of numbers. So some of you may be more visual learners. So we just tried to put some of these numbers into some charts. So here, this is just the historical growth of energy UPO versus the revenue. So back to Q1 2023, UPO was de minimis. It was completely worth ignoring. And energy revenue has kind of like ho-hummed along. All of a sudden by Q3, UPO has increased beyond the total energy revenue amount. And then that trend has just continued and accelerated. So like keep in mind, this will be future revenue. Like it's going to hit the books in the next, a good chunk of it in the next 12 months and all of it in periods thereafter. So if you're just looking at energy growth by looking at like prior, like quarter over quarter or like year over year, you're missing the story. Like the real story is this is going to be driving the future growth coupled with the gigawatt hour increase in deployments. So it's like very complicated to model this out as I think this exercise has shown. But if you're just like looking at year over year comparisons and trying to extrapolate based on that, like you're missing the story. So next, this is just a split of that UPO between the amount that's current, meaning going to be recognized in the next 12 months versus the long-term portion. So again, you can see here that the current portion is for near-term financial performance, the biggest or the most significant amount. And this is a very, very big jump that we're seeing here in Q2. And then next, these are getting into a bit of forecasting. So the silver bars here are the historical actuals. And then the blue bars are our forecasts for gross profit from the energy division. And so you can see it's, getting more and more significant at, nearly $1 billion per quarter. But going forward, I mean, it's just gonna really start increasing quite significantly. And then
exiting 2027 at $2.5 billion per quarter, close to it.
Yeah, which is getting close to $1 per share per quarter kind of territory, which is kind of wild. Although actually that's the next graph we have here is the energy contribution. So we're essentially, to get from gross margin to EPS, we're tax affecting and then taking another little sliver off for some overhead expenses. And when you do that, you can see we're getting to, the 50 cent per quarter territory by 2027. If this story takes off the way that we think it will, analysts are going to have to wake up and start adding this to their forecast. Saw a lot of downgrades with, price targets in like the $100 range. And it just cracks me up because these analysts aren't doing this work. They're kind of looking at like, oh, they missed on one quarter, I better lower all my future quarters expectations. And I think that's just the wrong way to approach modeling and price targets in general.
I'm very excited about it because I think it's a sleeper. I don't think it's been fully valued in the stock price or by the analysts. There are very few analysts, perhaps Morgan Stanley is waking up to this reality, but that's what's coming. That's what's coming. I mean, people are going to understand this. And, I'm waiting for the first analyst to actually pick this up.
Can I ask, what would it take for you to kind of revisit your hypothesis around here, especially as it relates to the 90% gross margin assumption on UPO? Obviously, we're assuming that the gross margin in percentage is going to increase. If that just stays steady at 25% or something, how long would that have to go on for you to kind of...
I think the next 2 quarters are going to be determinative. The next quarter may well show it, but if it's not shown in the next 2 quarters, I think we can scrub the theory. But in the next 2 quarters, we must see it because the number has become so large that it's very, very, very material. And it's unlikely that they're going to deliver another 9 gigawatt hours in the coming quarter. So, the actual contribution from the UPO must be fairly significant in the coming quarter.
I'm going to push back a little bit. I just realized this. So we just had this huge jump in the current portion. Is it possible that this portion was like 12 months away or more, and now it's less than 12 months away? So that big jump, a big portion of it is stuff that's like 9 months away.
No, it was the absolute amount that increased, not only the near-term portion, but the total amount increased. Okay. And the interesting part of it is that the bulk of that total amount was in the near term.
Yeah, so I think this is a big deal. Essentially, Tesla Energy is going to show itself to be like potentially 5 years ahead of what UBS is projecting. Tesla's 5 years ahead in a lot of other areas, like in the EV technology, making them profitably and all that. But this would be an enormous surprise to Wall Street. And we think that people are beginning to wake up to it. Yeah. But, given the big drop in the stock post earnings, not financial advice, it seems like people are kind of, missing that big story that happened from the production and delivery report, which is, a huge jump in megapack deployments.
Great work, Matt. Great work.
Yeah, well, awesome.
And definitely you too, Larry, because I wouldn't have gone down this rabbit hole and gone through all the brain damage today of reading through all these reports without you very publicly calling me out on it. So it was I appreciate all the digging that you did to kind of prompt this. Our model, I should just say, these numbers are definitely going to be wrong. The thing that matters is how much are they wrong and which way. Are we too conservative or are we too aggressive?
Yeah. Are we correct directionally is the biggest question of all. And that's what we have to discover.
Well, appreciate, Larry, all that you did on this front. Very much looking forward to the next couple quarters because I think you're right. Like the $2.5 billion being in the current portion of the UPO, like that can't hide for much longer. That's going to have to make its way through the income statement. And when it does, how do the margins react? I think that's the real question.
It's going to be really hard for Wall Street and the public to keep ignoring Tesla Energy. They're going to be forced to see it. Maybe it's in 2 quarters, maybe it's in 3. We're pretty certain that this is going to come through. And Tesla writes these contracts. They write the specs that they need to meet because they know they're going to exceed those specs. So this is a high certainty type of event for us. Not financial advice. We are financial advisors. We do have a position in Tesla. You can see our full disclaimer in the video description and on our website at rebellionaire.com. That's where we help people who have all-in positions in Tesla or in NVIDIA. We can help by adding covered calls, trimming and adding during the emotional highs and lows, and adding some small slices of some other stocks. Larry, we super appreciate your friendship and wisdom, and what you brought to us, and we're curious to see what comes of some of your research you're doing on the Tesla financials right now.
Yep, I'm deep into it, so we'll see. We'll see.
Larry's a regular contributor with Herbert and also with Randy Kirk. So if you want to see him regularly, he is over there.
Thanks, Brad.
All right. With that, I'm going to say thanks for your attention and bye for now.